Hello, welcome again to Engineering Economics, INEN 2373. In this video, we're going to talk about the most important financial reports of a corporation, that is the balance sheets and the income statements. And this is going to help you for your project. So let's first focus on your left-hand side of your screen, and you will find the balance sheet. The balance sheet is pretty much divided in two areas. One that is the assets on top, and then liabilities and capital at the bottom. The assets are the total resources that a company has in order to make their operations, and it is divided in current assets and fixed assets. The total of assets is 650,000, and that should match the total liabilities and capital, which is also for the most recent year 650,000. If you consider just assets now, it's dividing current assets. Current assets is everything that is going to be used within the next 12 months. In this report, that includes cash, accounts receivable, inventory, and prepaid expenses. Accounts receivable is anything that is already being sold to our clients, typically under credit, and they will be paying us within the next 12 months. Inventory is anything that is either a raw material, work in process, or finished good inventories. And prepaid expenses include things like prepaid insurances and rents and other legal fees, and so on. Fixed assets are assets that are to be used within more than 12 months, and the main idea is that we will keep them for longer periods of time, and if we use them, we want to account for the usage, we will be able to depreciate those. And depreciation has a big impact in the computation of taxes, but we'll explain that in a moment. So here the fixed assets that we have is machinery, furniture, and others. These others could include, for instance, patents and licenses. Now, if we go to liabilities and capital, we are divided, of course. The first part is just liabilities, and the other is capital. Liabilities is on its own divided in current liabilities and fixed liabilities. Current liabilities is anything that is going to be used or is going to be paid within the next 12 months. And fixed liabilities is anything that needs to be paid in more than 12. We have more than 12 months to pay it back. Capital is the actual ownership of the corporation. That is the owners, what's the wealth of the owners invested in the corporation, and it includes the original investment in stock. It includes the retained earnings over many years before. It includes the earned surplus for the most recent year. So when you add all the liabilities and all the capital, we match 650,000, which are all the assets that the company has. Also 650,000. That is, all the assets that we have are either owned by the corporation or owed by the corporation. Now let's take a look at the right hand side of your report, and we have the income statement. The income statement represents how much money was done in a particular period of time, whereas the balance sheet before represents an instant picture of what the status of the company is in a particular moment. The income statement represents a period of time in which we have to account for many transactions that occur in between two dates. So here we have, say for instance, for the most recent year, the net sales is 1,625,450. And then we have to compute how much it cost us to make those sales. That is, how much it costs us to acquire or manufacture those sales. Since this is a manufacturing company, we need to take into consideration inventory and materials and labor. I'm going to explain that in a moment. Let's just consider right now that the cost of the goods sold is $1,287,103. So if we subtract that from the sales of $1,625,450, give us a gross profit of $330,347. From that, we need to subtract different operating expenses that include selling expenses, depreciation and amortization, and general and administrative expenses. Depreciation in this case for 58,122 is a computation on how much we have used our fixed assets in the previous report, and that represent a cost even though we didn't pay particularly any cash to anybody, because we still have our equipment. We might still have our equipment. We just report this use of our equipment as a cost, and that has the benefit of reducing the profits and therefore reducing the taxes without having to actually pay that cash to anybody. So we subtract from the gross profit of 338,000 the total operating expenses of 224,586, leaving us a net operating income of 113,761. From that, we subtract the interest expenses. The interest expenses are just that. The financial expenses that we have is the interest that we pay on the loans that we owe, and the interests are considered a cost. And that's also an important aspect on how we should decide whether to finance or not our project from external resources, because when we finance our project with external resources, the interests are considered costs and therefore reduce the amount of taxes that we need to pay. So in this example, we subtract 21,600 from 113,761, leaving us a net income before taxes of 92,161. From that, taxes are computed, in this example 4,188, and the net income is reported for this year 51,973. Notice that this net income 51,973 matches the earned surplus for this year in the previous report, 51,973. Now let's go back at the top of the income statement, and you will realize that we still need to define how we computed the cost of the goods sold, and pretty much this is just a balancing computation in which we can identify the final inventory and or the ending inventory, and just by subtracting everything that was at the beginning and was added to the inventory and subtracting the less amount, the remaining inventory, we can identify how much of the inventory was went out in the form of the cost of the goods sold, and that's how we do it. So we actually add beginning inventory plus direct materials plus direct labor plus factory overhead, and to that we subtract the ending inventory, and that gives us the cost of the goods sold. And in this graphic, we also have at the bottom right a few quantities that need to be explained. Those are financial ratios. In your project, you will have to, for a particular company, identify the balance sheets and income statement and compute these financial ratios, compare them to their particular industry, and make a report. You will have a video explaining how to compute these financial ratios.